Thanks very much, Kostas. This is going to be kind of an unusual talk for me, and I hope you'll all agree that it's in the spirit of this conference, a little bit connected to the open directions topic we'll have this afternoon. And what I hope this talk can do is, the way I'm going to structure it is I'm going to spend the first third of the talk going over a paper that many of you in this audience have seen, but I would say most of you in this audience have not, which is my recent work with Peter Crampton and John Shim, now in the Quarterly Journal of Economics, on the design of financial exchanges. And what that paper does is it makes an economic case that the financial exchange design that's currently predominant around the world, the continuous limit order book, has an economic flaw, has a structural flaw, and that a lot of the negative aspects of high-frequency trading are symptoms of this underlying structural economic flaw. That part of the talk will be completely standard. I've given it a lot of times. Many of you will have seen it. I'm going to give it in a compressed and hopefully quite accessible form. But the remainder of the talk, what I hope will be at least the second half in time, is I'm going to talk about what I see as some open questions and directions for research on the design of financial exchanges that I think lie at the intersection between economics and computer science. There's a two-page part of the QJE paper towards the back, which I don't think too many people read, that makes a qualitative argument, no theorems, no data, that discrete time trading has important computational benefits over the current status quo market design, in addition to the economic benefits that are at the core of the paper. And I'll go over that argument in some detail, raise lots of questions along the way. It's much less formal than I'm used to, so it'll be the second and third parts of the talk will be qualitative, no theorems, no data. But I hope it raises questions, and I think that's in the spirit of this conference, is to raise open questions at the intersection of economics and computer science, and to suggest some fruitful directions for future inquiry, and do what I hope is a small bit of agenda setting. So the first part of the talk will be completely standard. The second and third parts a little riskier from my perspective, but qualitative, but I think quite important. Okay, so let me talk about the economic case, the economic case for what I'll call discrete time trading or frequent batch auctions over the current predominant financial exchange design, which is called the continuous limit order book. So the starting point is just to tell you what the continuous limit order book is. Just a quick show of hands, how many of you are familiar with this market design? It's about a third. How many of you know what top trading cycles is, just out of curiosity? So continuous limit order books process in excess of $1 trillion of economic activity per day, but less well known in the market design community. The basic building block of a limit order book is a limit order. It specifies a price, quantity, and a direction, buy or sell. For instance, buy 100 shares of XYZ at $100 per share. Market participants can submit limit orders at any moment in time during the day, and can also cancel or modify outstanding limit orders at any time during the day. These messages sent to the exchange, so new orders, cancellations of existing orders, are processed in continuous time, serially, in order of receipt. It's a serial process. The set of orders outstanding at any moment in time, so offers to buy, which are called bids, offers to sell, which are called asks, is sometimes known as the limit order book. And trade occurs whenever a new request to trade comes in that crosses the limit order book. So a new request to buy that has a price that is greater than or equal to some outstanding offer to sell, or a new request to sell that has an ask price that is less than or equal to some outstanding offer to buy. So that's the basics of a continuous limit order book. It's a continuous time serial process protocol. Limit orders are the building block. Let me now give you the conceptual critique of continuous time limit order books from the from my paper with Crampton and Shem. And I'm going to give you a stripped down version of that paper's model, which is already an extremely stripped down model. So there's a security, call it X, that trades on a continuous limit order book market. There's a publicly observable signal, call it Y, of the value of this security X. Y jumps around as a Poisson jump process. I'm going to make a purposely strong assumption, which is that X is worth Y. The value of X is perfectly correlated to this public signal Y, and moreover, X can always be cautiously liquidated at this value Y. These two types of players in this model, investors and trading firms. Investors are mechanical. They arrive stochastically to market according to some Poisson process, randomly needing to either buy or sell a unit of X. And then there are trading firms. There are N trading firms in the market. And I'm going to assume that they're all equally fast. They all have actually zero latency in this stylized setup. So if a trading firm decides at some time t that it wants to submit an order, cancel an order, that message reaches the exchange at exactly that time t. There's no latency. So what I'm trying to do with this model is to create an, if you will, best case scenario for price discovery and liquidity provision in this status quo market design, the continuous limit order book. I've assumed away asymmetric information. All participants know that X is worth Y. I've assumed away inventory costs. X is always liquidatable at value Y. Investors are mechanical. There's no latency in the system. It's a best case for this market design. So given this setup, you might conjecture that competition among the trading firms leads to effectively free liquidity for investors. I've stripped out all of the usual costs of providing liquidity in a financial market, asymmetric information, inventory costs, and so forth. So what you might expect is that if you're an investor, you can show up to market and buy X at Y. The trading firm should be willing to offer X at Y. That's not what's going to happen in this market design due to a phenomenon that we call sniping. So suppose I'm making a market in X. This is my bid. I'm going to use my hands a lot over the next few slides. So this is my offer to buy, my bid. This is my offer to sell, my ask. And I'm getting signals from other markets, call them Y. So this is the signal Y. And suppose this signal Y jumps, so from this level to say up here. So what am I going to do as a trading firm engaged in liquidity provision? I'm going to send a message to the limit order book saying cancel these quotes, this bid, this ask, replace with these quotes, this bid, this ask, that reflect the new public signal, new public information Y. Okay? So that's what a liquidity providing firm will do when there's a change in the public information. Cancel, replace. Okay? At the exact same time that I say cancel these quotes, replace them with these quotes, Twelmas, I'll pick on you if that's okay, is going to send a message to the exchange saying I want to buy at this old ask price. And Costas is also going to send a message to the exchange saying I want to buy at this old ask price. And in fact, the whole room is going to say I want to buy at this old ask price. So because the market is processing these messages in continuous time in a serial process, it's a bit random which one message reaches the exchange first. In fact, if there are N of us all equally fast, it's a 1 out of N chance that my request to cancel is processed before one of your requests to snipe me, to trade at my old ask price. So I want you to take three things, and this is all worked out in exquisite detail in the academic paper, but I want to give you three takeaways from this idea of sniping right now. So the first takeaway is that, yeah, please.
The signal is publicly observable. The signal is
yes. Yeah. So Y is publicly observable.
It's discrete time.
So it's a continuous time model. So so it's a continuous time model. It's a Poisson jump process. So at any moment in time, there might be a jump, in which case Y jumps from this level to this level, or this level to this level. This sniping phenomenon, which I've talked about in the last few slides, the reason the prior literature missed it is the prior literature had modeled limit order books using discrete time sequential move abstractions. which are really important and crucial for analyzing certain kinds of economic phenomena, but miss the possibility that when there's a news event, all 50 of us react at the same time to that news event, and then serial processing kicks in, and it's kind of random who gets processed first. So I want you to take 3 things from this little example with my hands. So the first is that mechanical arbitrage opportunities are built into the market design. You can make money, there are rents, from symmetrically observed public information. And this really isn't supposed to happen in an efficient market. We're all used to the idea that you can make money in financial markets if you know something the rest of the market genuinely does not know, if you have asymmetric information. But because of the market design, you can make money from symmetric public information. And that's really not supposed to happen. I would argue, a market failure. Second, the profits from these mechanical arbitrage opportunities come at the expense of liquidity provision. So when Thomas's request to snipe me is successful, that's an algorithmic trading firm engaged in sniping earning rents at the expense of an algorithmic trading firm engaged in liquidity provision. That's the liquidity provision function losing money to the sniping function. So these mechanical arbitrage opportunities, the profits from them come at the expense of liquidity provision. And if you make liquidity provision more expensive in a competitive market, that expense gets passed on to investors. That's why investors can't, in this model, costlessly buy X at Y, even though we all agree that X is worth Y. Yes?
That seems a little bit simplistic, because so in your scenario, what does Thomas do after he buys this thing? I mean, does he resell it, providing liquidity with it, or does he run off with it and consume it, or what happens?
Let me show you some examples, empirical examples, on the next few slides that will, I think, practically answer your question. In the model, Thomas has just bought something that he's bought something at a price here that is just costlessly liquidatable at this value. And I know it, by the way. The same time Thomas learns that this asset is costlessly liquidatable up here, I learn that too. Costas learns that too. The whole room learns this information at the same time. It's symmetric public information. But because of the market design, because of the continuous time serial processing, somebody nevertheless gets a rent from it. But I'll show you a concrete practical example that'll, I think, make it a bit more real, and I think maybe literally the next few slides. Okay, so this creates a cost of liquidity provision that gets passed on to investors and manifests in less liquidity in thinner markets. And then third, this sniping phenomenon creates a never-ending speed race, because it's in my incentive to get faster to get out of the way of Thomas, and it's in Thomas's incentive to get faster to successfully snipe me. So you can imagine where in each year we're investing in speed, getting faster and faster and faster, trying to win this race. Let me show you, to your question, let me show you an empirical example of one of these mechanical arbitrage opportunities. So these are the 2 most heavily traded instruments that track the S&P 500 index in the US, the E-mini futures contract that trades in Chicago called ticker ES, and the S&P 500 exchange-traded fund that trades in New York, ticker SPY. This is a trading day. It was a busy day. Prices are fluctuating a lot. But these two instruments are perfectly correlated over the course of a trading day. As you'd expect, they both track the S&P 500 index. There's a mechanical arbitrage relationship between the 2 of them. This is an hour of data, a minute of data, and then this is what the market looks like when you zoom into high frequency. This is 250 milliseconds of the day. And what you see is instruments that to the human eye look like they're moving in perfect lockstep, as you'd expect, given the asset pricing relationship between the 2 of them, at high enough frequency move in a much choppier fashion. So here's the price in Chicago jumping. The price in New York doesn't react for quite a while. So the answer to your question is you can't. You would be the arbitrage opportunity would be to buy New York cheap, sell Chicago expensive, and then that would be that's a hedged position. You're long some S&P 500 in New York, short some S&P 500 in Chicago, and there are fancier and less fancy ways of executing that trade. But that's the nature of these kinds of arbitrage opportunities. And what we did, oh yeah, go ahead.
So for comparison, how would you estimate the bid-ask spread on the same graph?
So we don't have to estimate anything. We can see it in data. I'm showing you bid-ask midpoints.
So how large is the spread?
How large is the spread? The spread's a quarter index point in Chicago and a tenth of an index point in New York.
So like these 2 index point gaps, this is like a huge gap.
Yeah, this is a big gap. Yeah, there is a lot of. I picked a big one for the slide. There's a lot of money to be made at this moment buying cheap in New York, selling expensive in Chicago. And what we did was we looked at all instances like this one where net of bid-ask spread costs, you could make money buying cheap in one market, selling expensive in the other market. And we counted their frequency. We counted how long they lasted, so how long until the arbitrage closed, how profitable they were. And I'll show you some time series facts on that over the next few slides. So this slide shows you that the duration of these arbitrage opportunities came way down over the course of our data. From 2005, they lasted in excess of a tenth of a second. By 2011, they lasted less than a hundredth of a second. And this is a fancier way of showing the same thing. The profitability of these arbitrage opportunities was pretty flat over time. The frequency varied over time, but the frequency was driven almost entirely by just asking how volatile was the market. The more volatile is the market, the choppier is the market, the more arbitrage opportunities there are. And this is my favorite way of summarizing the empirical facts is the horizontal axis here is time from a millisecond up to 100 milliseconds. The vertical axis is correlation. The correlation between these two assets should be 1 or 0.99 something based on their asset pricing relationship. What you see is at 100 milliseconds, you see the correlation getting higher and higher in each year of our data. That's information getting from Chicago prices into New York prices faster and faster each year and vice versa. At high enough frequency, though, at a millisecond, the correlation breaks down entirely. So the analog is, this is the duration of arbitrage opportunities getting shorter and shorter each year. And this summarizes that there's nothing in the market design that can prevent the arbitrage opportunities from occurring in the first place. Yes?
So, when these arbitrage opportunities exist, the gap might be large, but the volume that you could execute and exploit is not arbitrary. Let's say it's like the volume at the bid or the volume at the ask or something.
Right.
So in principle, you could do an accounting exercise where you computed, let's say, the total market value to all participants in this kind of arbitrage in a given year. Do you have an estimate of what?
Yes, in this one, so we could do it in detail for this one trade, and it's on the order of $75 million a year. And we think that's an underestimate for a variety of reasons. But think of that as the order of magnitude for this one trade. How you scale up this one trade to the universe of all mechanical arbitrage opportunities. So, here's
I mean, these are the most liquid instruments in the market, right? So
these might be even more, right? So here's Treasury markets. High frequency data isn't researcher available in Treasury markets. Here's a list of other highly correlated pairs that we put together kind of for fun.
But they're probably much lower liquidity than SPY and the minis, right?
Yes, SPY's a big one. I agree.
I'm just wondering whether, whether the total market share, let's say, is more than $1 billion a year. Yeah, I would be comfortable betting on that. Although the data that you'd want to perform that exercise isn't that researcher available. I mean, the data I used for this exercise is direct feed. Not to get too deep into the weeds, it's direct feed data from the Chicago Mercantile Exchange and the New York Stock Exchange. Buying the data, storing the data, and processing the data is on the order of 200 grand. It's not trivial for academics to do that. The firms that have access to it don't share it with academics. I think it'd be great for somebody to do a more thorough accounting exercise, but that's not been doable by academics. Okay, so let me talk about now frequent batch auctions. I'm going to go through this quickly so I can get to the computational part of the paper. So at a high level, frequent batch auctions are identical to continuous limit order books, but for two key design differences. One, time's treated as a discrete variable, not a continuous variable. Two, orders are processed in batch using an auction rather than serially in order of arrival. A bit more fully, let's say the batch interval is 100 milliseconds, just to fix ideas. During the batch interval, traders submit bids and asks that can be freely modified, canceled, withdrawn, as before. If an order isn't executed at one discrete time interval, it carries forward to the next discrete time interval until either executed or canceled, just like standard limit orders. At the end of each interval, the exchange batches together outstanding orders, computes market level supply and demand curves. Supply and demand either intersect or they don't. If they do intersect, transactions occur at the market clearing price. It's uniform price auction. Priority is still price than time, but with time treated as discrete. So if I've been in the order book for many hundreds of milliseconds and you're new to the order book in this 100 milliseconds, I have priority over you. If we arrive in the same interval, we have the same priority. An information policy is analogous to continuous markets as well. What that means here is trade by every message, you send it to the exchange, it gets economically processed by the exchange and then disseminated publicly. The economic processing, though, occurs in discrete time, so information dissemination is in discrete time as well. Just to go over a couple of cases to make this a bit more clear and real. So one important case is in most instruments in most 100 millisecond periods, nothing really happens. So what happens in a frequent batch auction if there's no trade during an interval is there's a supply curve here in red, a demand curve here in blue. All orders just carry forward to the next discrete time interval, analogously to displayed liquidity in a limit order book market. The second case is there's a small amount of trade. So here's a investor showing up and buying at the ask. That's also analogous to the limit order book market. And the third and quite different case is if there's a burst of activity in the interval. So say in this particular 100 milliseconds, there's a news event and lots of algorithms are responding. This is the case where continuous and discrete are quite different. In continuous markets, this burst of activity is processed based on speed competition, who's first to trade at the old price. In the discrete market, this burst of activity is processed using an auction. There's price competition. And this helps liquidity in two ways. So one is as a liquidity provider, I have until the end of the interval, until the end of the 100 milliseconds to change my quotes, to cancel these quotes, replace them with new quotes, and prevent my stale quotes from getting entered into the auction in the first place. And second, liquidity provision is protected by the auction, because if I don't change my quotes and Thomas tries to buy from me and Kostas tries to buy from me and so does the whole rest of the room, you have incentive to bid more than my ask price to win the trade in the auction. So if you work through the equilibrium analysis, and this is all done in detail in the paper, of course, frequent batch auctions enhance liquidity. They stop by eliminating sniping, they stop a socially wasteful arms race. The cost is that investors have to wait a non-zero amount of time to transact, and people can disagree on whether that's a big cost or a little cost.
So, before you move on, so there are still discontinuities in this model, right? So there is some interval. Mm-hmm. Like if sort of like I fail to update my prices before the end of the interval, maybe you can snipe me before you got it in before.
Right. So let's say that you're a millionth of a second faster than me, and that's a relevant time scale, by the way, in modern markets. So maybe you're 10 millionths of a second faster than me. If there's a news event that is in the part of the interval where your 10 millionth of a second advantage over me allows you to act, but does not allow me to act because I'm a little bit slower than you, then you may be able to snipe me. So the ratio to have in mind is delta over tau, where delta is the speed differential and tau is the batch interval. In a continuous market, if you're a tiny bit faster than me, you always snipe me. In the discrete market, it's delta over tau. And then the auction-based competition means that if you're 10 microseconds faster than me, but so is Thomas and so are 20 other guys, you now have to compete in an auction to trade with me rather than competing on speed to trade with me. Yes?
How would this work if, like, one market adopted this and the others didn't, or even if all of them adopted this? Are you imagining that all the different markets are using the same synchronized clock, or?
That's an important practical question. So let me give you a couple quick thoughts, and we can talk about it more at the end. So the first thing to note is that in the current continuous market, law of one price is violated constantly, right? Because in a continuous time market, if a price changes on NASDAQ, the price isn't going to change at exactly the same time on New York Stock Exchange. It's just not detectable with human eyes. And it's not detectable with researcher available data, because researcher available data isn't finely time-stamped enough. So if this were done if frequent batch auctions were adopted by multiple exchanges at once, you'd be able to detect law of one price violations in a way that you can't in the current market design, but that doesn't mean that it's better or worse. It's just you'd be able to detect it because the data would be clearer. A second thing to say is that if a single exchange went to discrete while others remained continuous, that one exchange that went discrete would be eliminating latency arbitrage on its exchange. That's like eliminating a tax on liquidity provision on its exchange. And an economic intuition is that if there's two exchanges, A and B, and on B there's a high tax of providing liquidity, and on A there isn't, over time we would expect A to be able to win. Now there are some frictions against A winning. There's a coordination challenge of launching a new marketplace. There's regulatory ambiguities that the SEC chairs talked about in the context of this work. And there's also vested interests. There's a lot of money to be made by exchanges from the status quo design where, among other things, they sell co-location services, they sell proprietary data feeds, they sell microwave connections between exchanges. So I think it's an important practical question, one we could talk about at length later. Yes?
You feel free to defer this, but it seems natural from Ava's question. I imagine you have an opinion on IEX's proposal to instead just insert latency into every order, but to keep a continuous time exchange.
Yeah, so let me tell you how IEX works, and I'll give you my kind of 1 minute response on that. So the way IEX works is here's the market, the world changes, IEX has this 350 millionth of a second speed bump. So if Thomas comes to try to trade with me, Thomas is delayed by 350 millionths of a second. If I try to remove my quotes and adjust them, I'm also delayed by 350 millionths of a second. But IEX sees that the world's changed in 200 millionths of a second and automatically slides my prices to reflect the new information. So I think that's quite ingenious. The liability of that design is it requires IEX to know where to look for prices. So when you hear the IEX guys talk about their market design, they always say, well, where do you get prices from on your market? And I always think, well, where I get prices from my market is from my market. It's a market. The whole purpose is to discover prices. But if you think through the mechanics of their market design, it really relies on being able to look elsewhere for price information. So I think it's ingenious. I don't know what they'll do. Right now they're 1.5%. I don't know if it works if they're 20%. If they're meaningfully contributing to price discovery and not just looking to prices elsewhere. So I think they exist. That's better than I can say. But I think that's the weakness of their design relative to mine. Yes?
Following up on that, what if you just introduce a random delay? So it's not delaying everything the same amount, but random delay.
Good. So random delay, we have an equilibrium analysis. It leads to infinite message traffic and does not address sniping. So there are many ideas that have been batted about by folks with game theoretic intuitions, most of which are bad, and I can analyze them in the paper. And I don't mean to pick on you. But we. Right, it's good to throw spaghetti at the wall, right? But no, that's one we can analyze. I think the thing I would emphasize is that, and this also relates to the IX question, I think our paper identifies continuous time serial processing as the root flaw. It creates rents from public information. The rents from public information harm liquidity, induce a speed race. The solution to that is to make time discrete and batch process. And there are lots of other intuitions you could come up with if you think the problem is an arms race and let's just stop speed competition. But I think the root problem is a flaw in the market design, and we directly address that. So I've got about 8 minutes. So I'm going to go through what I hope to spend most of my time on, but that's fine. I'm happy to get sidetracked, which is the computational advantages of discrete time trading. This is the qualitative part of the paper. It's 2 pages towards the back, and I hope raises questions that I think a combination of economists and computer scientists could find fruitful to address. So the context is that there have been a lot of computational issues with modern financial markets. There have been flash crashes that have gotten a lot of attention. There's a flash crash in equities in 2010 and treasuries in 2014. There's mini flash crashes in individual stocks on a more regular basis. There's a mini flash crash in Google stock just for Halvarian's benefit. Been numerous exchange glitches. There have been coding errors have gotten a lot of attention. What I make an argument for in the paper towards the back is that discrete time has computational simplicity advantages relative to continuous time. and with specific benefits we describe for exchanges, algorithmic traders, and regulators. And the rough intuition is that continuous time markets often implicitly assume that there's no latency and that computers are infinitely fast. And computers and communications are very fast, but not infinitely fast. And discrete time respects limits in ways that simplify markets. This is a qualitative, informal argument. Again, I bring it up here. I put it in the paper in part to respond to the concern, well, you're proposing a new market design, what about unintended consequences? And the unintended consequences folks often reach for are these kinds of computational glitches, dramatic computational events. And I wanted to say in the paper, well, if anything, I think the computational case favors discrete time over continuous time. Continuous time has had all of these negative consequences for markets, but it's informal and qualitative. So I thought it was useful to include in the paper, but it's informal. So let me go through the computational benefits for exchanges. So in continuous time, exchanges face a problem of backlog. So processing any single order is computationally trivial. Disseminating a message is computationally trivial. Trivial operations take non-zero time. You don't need to be a computer scientist to know that. And an implication is that when there's a lot of activity, exchanges might get backlogged. And this is a graph showing the backlog that the Chicago Mercantile Exchange faced during the Treasury market flash crash last October. And what this means is that algorithms are left uncertain about the state of their orders and the state of their market precisely when there's a lot of activity, precisely during times of duress. Discrete time, batch auctions are also computationally trivial. They're n log n. And you can set the batch interval to be long relative to realistic worst-case processing time. So I had an RA use a laptop to figure out how long it takes to run batch auctions at the level of message activity during the flash crash, and you could clear batch auctions in 10 milliseconds on an ordinary laptop using C++. So it's not, you could use a realistic batch interval and have a cushion relative to a realistic worst-case processing time. I think a research question is the economic consequences of backlog. On the one hand, 60 milliseconds of backlog in a black swan event's pretty good. On the other hand, it occurs precisely during times of confusion and duress. A second computational benefit of discrete time is it simplifies message processing details for exchanges. So if there's a large trade that triggers a lot of messages, it triggers trade updates to participants in the trade, and it triggers book updates to the market as a whole saying that the price is updated. In continuous time, exchanges have to make a decision about the order in which to disseminate these messages. The Chicago Mercantile Exchange's matching engine sent out the trade updates before the book updates. So savvy high-frequency traders figured out, well, if I put sentinel orders in the book, I can get information that there's been a large market move before it's publicly disseminated that there's been a large market move. In discrete time, all of this stuff goes away. You can disseminate messages at economically the same time. Another computational benefit of discrete time, I think, is with respect to exchange glitches. Discrete time just simplifies the programming environment in various ways. As an example, NASDAQ, at least when I last spoke to them, threaded all message activity through a single core for the purpose of timestamping. So there was the whole NASDAQ marketplace. There was one core that was in charge of supplying timestamps for the market to figure out, did this action in this stock occur before or after this action in this stock? And this becomes unnecessary once you treat time as discrete. I think an open research question is, well, simplifying the computational task of an exchange, does that have any connection to these more dramatic glitch incidents? Okay, let's now talk about some computational benefits of discrete time for algorithms. The basic contrast between continuous and discrete is in continuous time, you get a piece of data, and you have an immediate trade-off, which is, do I respond immediately, or do I think about that data? So there's an intrinsic trade-off between speed and smarts. And algorithms have to optimize over the decision of how much to think about a piece of data before responding. In discrete time, you get a batch of data at time t, make decisions for time t plus 1. There's still a trade-off between speed and smarts, but if the batch interval is 100 milliseconds, in a sense, the first 100 milliseconds of thinking are free. They don't have a cost in terms of time priority. And the research questions that come out of this, and this is a quote, let me give you, this is a quote from a wonderful article by Donald Mackenzie, who's an economic sociologist at Edinburgh. He was talking, he did interviews with HFT programmers. One of them was saying, well, there are rules you need to follow to write fast code, one of which is you never use an if-then statement. That slows you down too much. And then here's another great quote. It took 52 seconds to realize I'd made a mistake. By the time I pressed the red button, we'd lost $3 million. They computed that in another 20 seconds, the firm would have been bankrupt. In another 50 seconds, their clearing firm would have been bankrupt. And then they went on to say that the whole system would have blown up in another couple minutes. I don't know if that's an exaggeration, but I think the questions for research are one, I think this trade-off between speed and smarts is quite interesting and seems quite hard to model. A second question is, are there negative externalities from this speed smarts trade-off? So if I make a dumb decision, I'll lose money. Does that have negative consequences for the market as a whole? This quote suggests the channel through which it might. And the last question is, how is the accuracy of prices affected by this speed smarts trade-off? I think that's that's a subtle, hard question. On the one hand, in a continuous time market, firms get more data. High-frequency trading firms get more data than they would in a discrete time market. That seems good for forming a view on price. On the other hand, they're incentivized to respond to that data in a way that's fast as opposed to smart. That seems counterproductive for the efficiency of prices. It's just hard modeling questions. For the regulator, discrete time leads to a cleaner paper trail. So in continuous time, you have to adjust the paper trail for relativity, clock synchronization mistakes. It's non-trivial to figure out, did this action on this market happen before, after, or at the same time, than this action on that market. In discrete time, that becomes trivial. I think the benefits of a clean paper trail is an open question. My intuition is that they could be large, much in the same way that we all have an intuition that a website with good user interface can have large, good user interface design can have a large benefits for a website, even if you could perform the same actions without the good user interface. But I think it's a hard question to get traction on. Another computational benefit of discrete time is symmetric dissemination of public information. In continuous time, it's technologically non-trivial to impossible to disseminate information to multiple parties at the same time. This is manifested in a couple of high-profile controversies. And even if you could disseminate information at exactly the same time, the model shows that economically that those messages would be responses to that information will be processed as if it were disseminated asymmetrically. In discrete time, all of this goes away. It becomes technologically trivial to disseminate information to multiple participants at the same time. So I think I'm out of time. Let me just mention a few other questions that I won't spend time on, but let me mention a few other questions for future research. So one is just flash crashes. I think it's an interesting topic. The causes of flash crashes we don't understand. The economic consequences of flash crashes we don't understand. And then the effect of market design on the likelihood of flash crashes, I think we also don't understand. I think circuit breakers is another interesting topic for future research. The idea of a circuit breaker is, well, if there's an extreme event, let's take a pause before resuming trading. I think this raises conceptual questions as well as design details questions. So just to recap, the heart of my QJE paper is to make an economic case for frequent batch auctions over continuous time trading. It eliminates rents from public information, enhances liquidity, and stops a wasteful arms race. We also, towards the end of the paper, have this two-page qualitative section making a computational case for frequent batch auctions. The arguments are informal. They're included because of the importance of the topic and to respond to this concern about unintended consequences. I think they raise open research questions and would naturally benefit from a mix of Econ and CS tools. And then I'll end with a plea, which is more generally, there are a lot of open questions about the design of financial exchanges. These are huge, important markets. And I think there are a lot of questions that would benefit from a market design approach and toolkit and perspective. There's a fixed cost you have to pay to do research in this area, which is to learn the relevant institutional details. But I would strongly encourage, especially young folks in this room and young folks who people in this room know, to incur those fixed costs. I think there's a lot of important work to be done. Let me stop there. I'm happy to take questions or to take questions at lunch. Yes.
A lot of these markets have designated market makers, and the SEC has certain rules as to how they get to operate. And I don't know the new rules. At one point there were rules like you have to honor the old quotes at least so many times before you get to change them, and so forth. So have you thought about how that changes these results at all?
Yeah, I have a bit. So taking a broad view of the last couple decades of history, we've switched from human-based trading to electronic trading. We've switched from markets with designated market makers, so specialists, for example, to markets mostly without designated market makers. We've also shifted from trading in quarters of dollars to pennies in the case of stocks, and other markets have gotten finer. The historical record's pretty clear that liquidity in markets is better today than it was, say, 20 years ago. Computers are smarter than humans at aggregating and analyzing data, and also easing price constraints has been obviously good for markets in ways that have reduced the cost of liquidity. I think one thing we got wrong in that transition from humans to computers kind of relates to that question, right? If I'm making markets in the good old days, and suddenly this whole room starts yelling at me, wanting to trade with me at my current price, I kind of have some discretion. If you look at the rules, there's a little bit of discretion over what to do in that circumstance, that suddenly all at the same time to human perception, the whole room starts yelling at me to trade at a price. So I don't want to say that you could run a batch auction. That would be an overinterpretation of the old rules, but there was some discretion, there was some scope for favor trading. When we transitioned from the human-based specialist market to an electronic limit order book, we coded up the limit order book, treating time as a continuous variable, serially processing all trade requests. We treated time priority as infinitely fine, down to the nanosecond. And I think we kind of introduced this glitch. So overall, the transition from the designated market maker human era to the computer era has been good for markets, but we introduced this glitch in the transition. And a lot of the negative aspects of high-frequency trading, I think, are consequences of this glitch.
I guess you're associating designated with human, but there are more designated market makers that are computerized nowadays. So I was wondering, do they still have to take the quotes? Even if everybody's yelling and they want to buy from me, I have to sell a certain number before I jump. And how does it affect your sniping results?
So those rules vary a lot by exchange, by country. So conceptually, having a designated market maker with obligations to trade even in times of duress it's hard to do, right? Because in the 87 crash, if you were a designated market maker, you just stop picking up your phone because you don't want to make markets. There's too much uncertainty. Now, if you're a designated market maker, you can widen your quotes, or flash crashes you can think of as the non-designated market makers, the equilibrium market makers in a market without designated market makers rationally decide not to offer liquidity. There's too much uncertainty at this moment in time. So I think it's a hard question. I don't think there's any one answer to your question. I think it raises a lot of interesting issues.
So in the interest of time, let's thank Eric again. And